All right, good morning, everyone. My name is Jason Delisle. I am a resident fellow here at the American Enterprise Institute, where my work focuses on higher education policy, financial aid, and a lot on student loans, which is the topic today, and thank you all for coming. The topic of student loans today will be a little bit different, though. A lot of the conversation, a lot of the policy conversation, a lot of the media conversation about student loans has focused on how much debt students have. Do they have too much? Do they have just the right amount? And also, should it be more subsidized? Should the government lower the interest rate for students? So those are the conversations that have really dominated the debate. Today's a little bit different. I'd like to focus on, and we're all here to focus on, what is the government's role in the student loan market? Should it be different than it is today, or is it about right? So for example, just to set the stage, the government's role right now in the student loan market is pretty much so total dominance. The federal government, through its direct loan program, makes about 90% of all newly issued student loans in the country. So the direct loan program, this is the government's loans being lent directly from the Department of Education to the student at the college that they attend, with federal money and held on the government's books. So how does the government, how has it come to dominate this market? Well, first, it offers everyone a loan, no questions asked. So it's an entitlement, and there's no underwriting. There are really no standards. If you show up at a school, at a college that's able to accept the loans, you can get a student loan. And the terms are well below market. Right? The interest rates are heavily subsidized. Some of the loans don't accrue interest while they're in school. And there's generous income-based repayment plans with loan forgiveness. Another way the government dominates this market is it makes unlimited loans to parents and graduate students. There's no cap. So for undergraduates, the government cuts you off after a certain amount of money each year, or in total. But for parents and for graduate students, parents of undergraduates, there's no limit. Whatever the school charges for all expenses, including living expenses, that's what you can borrow. There's no annual limit and no lifetime limit. So you put all this together, and what you have is a student loan portfolio that the federal government holds, and some loans held by private lenders but backed by the federal government, that is now about $1.2 trillion. That rivals the federal government's mortgage program through the FHA. So these are now the two largest programs are about on par, mortgages and student loans. So we have a conservative and a Republican legislature and White House. So this total dominance of the student loan market, naturally, is something that keeps them up at night. And what I hear around Washington and in various conversations is, we need to get more private capital into this program because this is too much of a government program. And I sort of squint and I say, well, what do you mean by that? More private capital in a government program? I mean, it's sort of, those are kind of mutually exclusive things. And it turns out nobody can really take the next step. They can't explain to me what that means. So that's one of our goals today, is to try to figure out what people mean by getting more private capital into the loan program. Or do they really mean the government just needs to pull back and private lenders will step in? Now, in some cases, though, when people talk about their concern over the size of the student loan program, they actually have a very specific solution, or what appears to be a solution, which is going back to the guaranteed student loan program that existed from the 1960s all the way until 2010. Now, I said earlier that the government makes all the loans with its own money, directly to students. But prior to a changeover to that system in 2010, private lenders made the loans, and the government insured them against default losses. So when I say to people that I think there's some interest in going back to this. Just yesterday, on the phone with a reporter, I said, really? Are you really hearing that? They said, well, let me read some things to you. So for example, about a year ago, the press reported that President Donald Trump's campaign was, quote, planning on moving the government out of lending and restoring the role to private banks as was the case before President Obama fully shifted loan origination from private lenders to the government. So there's the president, his team, talking about it, although that was a year ago. Maybe they've changed their mind. A lot of stuff changes with this administration. And Representative Virginia Foxx, who's now the chairman of the House Education Committee. Here's what she said after the 2016 election. She said she wants to reverse a Democratic Congress's decision in 2010 to make all federal student loans through the direct loan program. So those are pretty serious policymakers who are talking about returning to the guaranteed student loan program. And that's sort of our other goal here today, is to say, is that the right approach? Is that a good policy? There seems to be a lot of confusion about whether or not that's a good idea. For example, the editorial writers at the Wall Street Journal seem to think that everything bad that has happened in student loan land since 2010 is because of the switch to direct loans. For example, rising debt, rising defaults, and pretty much so, and even the income-based repayment program. That's not exactly how it works, and that's a good thing that I think all of us can help clear up today. So I'm going to kind of give you the ground rules for discussion, and then I'm going to introduce all the panelists. So want to make sure everyone has silenced their cell phones. The hashtag for the event, if you do Twitter, I know some of you don't still, you probably should though, its hashtag is AEI Student Loans. And at 10:15 today, we're going to open everything up to questions, and people can ask questions to the panelists. You can also ask questions via Twitter. We'll be monitoring that. Please introduce yourself when you do ask a question, not a long statement, followed by don't you agree. And the event will be live streamed, and it will be archived, so you can watch it over and over and over again if you want to. So let me introduce the panelists here. Beth Akers is a senior fellow at the Manhattan Institute, but more importantly, she's here today because she worked in the President's Council of Economic Advisors under President Bush and worked on student loans and the now defunct Guaranteed Student Loan Program. Next to Beth is James Bergeron. James is president of the National Council of Higher Education Resources. It is a trade association that represents state, nonprofit, for-profit education finance organizations. James was a senior staff member of the House Education Committee. And for those of you who don't know, the organization that he represents primarily used to represent lenders in the guaranteed loan program, and now has a broader and slightly different role. Next to James is Rob Lavitt. Rob is general counsel for SoFi, which is an online personal finance company that refinances student loans and makes mortgages and personal loans. And so Rob is here also. So Rob has experience in private capital, but most importantly, or even more importantly, he has experience in the old guaranteed loan program, where for many years he was a general counsel for Sallie Mae, the largest lender in that program. Next to Rob is Zakiya Smith. Zakiya Smith is a strategy director at the Lumina Foundation, the nation's largest foundation dedicated solely to higher education. But before that, she was a senior advisor for education at the White House Domestic Policy Council for President Obama, where she worked on student loans. Last is Mike Grunwald, I'm going to turn it over to, who's actually going to moderate today, because I've rigged the panel such that I'm going to be on it. And thought someone else should also moderate then if I'm going to be on the panel. For those of you, if you're not familiar with Mike's work, he's a senior writer for Political Magazine and editor-at-large of The Agenda. Mike has a strange interest in government loan programs. He likes to write about them and cover them. It's fairly niche, but you know, I understand, I sympathize. An article that Mike wrote, he's dared to call the Parent Plus loan program for student loans that I talked about earlier, the government's predatory loan program. He also discovered a government loan program that has a 116% default rate, meaning people default on more than they borrow. So just think about that for a little bit. It was something he asked the government about, and they didn't have great answers. So I'm hoping that he's able to get some really great answers out of the panelists today. I'll turn it over to Mike.
All right, thanks a lot. Thanks everybody for coming. I know this is the big news of the day. So it's true. I'm a little obsessed with government lending, partly because there's this sort of weird Goldilocks problem when the government gives a loan, right? Normally lenders lend to people that they think are going to pay it back. But with the government, if you're lending to somebody who's going to pay it back, the question is, well, then why are you making the loan? But of course, if you're lending to people who can't get paid back, you're not getting paid back. And that seems to be one of the issues with the student loan program. Certainly with guaranteed loans, as Jason said, there was no underwriting. Everybody could get a loan, but there was, and if they didn't get paid back, the government would cover the cost, but there was still private involvement. I was going to start by just asking for a show of hands on the panel. Does anybody think we should go back to that guaranteed loan program? Oh, that makes it easy. So there's still a lot of questions about student loans. And actually, I thought and this is something that Beth has written a lot, but I thought I'd just throw out there again, is there a student loan crisis? Show of hands.
Oh, I think there is one.
All right.
Not the one you're thinking of, though.
All right.
Also, there are many crises. How about that?
Exactly. Well, it's
not the biggest crisis in higher education.
So let's start with that. If there are problems in the student loan program, what are the few that you would start by fixing? And let's just go through the whole panel and start with Beth.
Sure. So if there's one thing to start with, I'd say it's simplification, both on the front end and on the back end of the lending program. So students who interact with the federal lending program, both with themselves and with their parents, have access to, I believe there are 6 different types of federal student loans, which makes it very difficult for students to understand the full extent of their borrowing portfolio. And on the back end, they have some large number of repayment plans, which we believe that they are not interacting with very efficiently, very likely due to the fact that it's a very complex system, number of different programs with different eligibility requirements and with different benefits. So if I were to be able to fix one thing, that would be it. One loan in a single repayment program with a default enrollment into income-based repayment.
So I think simplification is definitely one of the items that should be at the top of everyone's radar screen. I think additional financial literacy, to help students understand, what is the best college for them to go to, as well as, what is the best loan product or what is the best federal financial aid that they should take advantage of. What is the best repayment option for them to partake of based on their unique needs. What's how much they're going to have to pay back monthly. Just kind of a whole host of issues that I think is really a challenge and really kind of focus on the front end of the program. But I think it's a larger, I'm going to go on a little bit. I think really kind of maybe the overall issue that federal policymakers need to focus on is whether or not the federal government is running a student loan program or whether it's running a student assistance program, because those are two very distinct items, and they're very distinct products, and that will determine largely, in my opinion, where the role of the federal government is, and then what type of subsidy should be based around those programs, and what experience the borrower should do. And so we don't really have clarity, I believe, at the federal level on kind of how those various dynamics play. On the private lending side, we run private loan programs, and that's kind of the distinction that we have right now in the current market.
I would come up with at least 4 ways to try to fix the student loan program. So number one, the complexity that Beth talked about. Jim, I've been in student loans a long time, and I can't even understand all the repayment options that these kids have when they get out of school. I don't know how they can understand the myriad of options that they have, so that complexity. 2, I think there has to be much more skin in the game for the schools. So I was at Sallie Mae a long time. We would get blamed for a lot of things, some deservedly, some undeservedly. A lot of it was, we were blamed for schools raising tuition, which we had nothing to do with. So schools should have some skin in the game, and I wonder whether schools that have multi-billion-dollar endowments, should they really be participating in the student loan program, or should they be dealing with their students themselves without federal involvement? 3, I think the PLUS program should either be eliminated or drastically scaled back. So Grad Plus to me makes no sense. If grad schools are producing quality programs and getting their students graduated, the private sector can finance that. I think Parent Plus should be underwritten as well, and the Plus program should be underwritten. And then fourth, our company, SoFi, started 4 years ago. We invented a new product, which was refinancing. I think we've refinanced about almost $10 billion now in mainly federal student loans at a lower rate. So I think graduates should be told about the opportunities to refinance as part of their exit counseling. It's not for everyone because you're giving up certain benefits, but for a lot of people, we're providing a lot of value besides just a lower rate. We're doing placement services for borrowers who get unemployed. The government should think about maybe something like that as well. So those are my ideas.
So how you fix it depends on how you define what the problem is. And so my perspective would be, what are students facing? And regardless of whether we think there is a student loan bubble or a student loan crisis, certainly in the popular kind of opinion and among students who have recently graduated or even older adults, just you ask your mom, your grandma, or whatever, they feel like there's a problem with student loans, and they feel like there are too many student loans and that they are difficult to repay. And so we should do something to ameliorate that feeling among people. And I do think the complexity of the repayment system, but also the lack of information on the front end is associated with that feeling that people have. So if you just kind of think back, if you went to college and you took out a loan, I hate to do this, and David, my colleague David, who's here, is like, you are not the average college student, but just for sake of purpose of doing this exercise.
Probably in this room, you're average.
Yes, you're average within this room, but not within the larger population of college students, right? Did you know how much you were likely to finish with based on the length of your program, which is something that you could probably give people a sense of? Programs that are, if you go to a bachelor's degree program and you have tuition, it's likely to go up, but even if you just estimated that tuition remained the same, it would give you a sense of how much debt you would likely graduate with. Was that something that somebody told you when you signed any paperwork for student loans? Based on that amount of debt, did anyone tell you what your monthly repayment would be if you were defaulted into the standard loan program? Did they tell you what repayment options would be? I guess I'm saying this because, and you are probably above average in terms of the type of student that borrows in the student loan program, in terms of your likelihood that your parents went to college or your understanding of financial systems. There are many older adults, people who are returning, people who are the first in their families to go to college, and kind of thrusting them into this with no contextual information guarantees that when they graduate and have to repay, they will be frustrated and resentful at the process. So we should do a better job of helping people understand what that commitment is on the front end. I think simplifying the number of programs is kind of less important than giving people a better sense of what they're entering into. I just can't imagine I can't think of any other loan program where you sign up for the loan and they don't tell you how much you're likely to repay, or like what your monthly payment is going to be. That's kind of like lending 101. So we just do a poor job of that.
Well, truth in lending applies to private loans, but not federal loans.
There you go.
So I guess I would say, I was sort of to your point of how do you define the problem, right? I have a paper out in the hallway here that was for pickup.
Today?
That's right, conveniently out today. It's 25 pages of problem definition for you, Zakiya. But no, really what it is it walks through some of the history of the student loan program, and how we got here, and what was the rationale for the program to begin with? Why did Congress and the president create a student loan program? And in the 60s, it was that there was no private market for student loans. It didn't exist. And so the goal was to, kind of kickstart that market a little bit with a small federal role and some small federal subsidies. And 4 years later, just 4 years later, the federal government is running the whole thing. And then they start expanding the categories of students who can get loans. And that's the long arc of this history. Suddenly, we're making loans, the government's making loans to parents. And now, as of 2006, it's making unlimited loans to graduate students. Now, if you think about the rationale for a student loan program, which is to make loans to people who can't get loans in the private market, it seems to me that graduate students don't really fit the mold. And so you've got, the impetus for the program was there wasn't a private market, and now we've come so far, I think the federal government is essentially crowding out places where there would be a private market. And I think graduate school loans is a great example of that. So I think the solution is to repeal the Grad Plus program, maybe even go further, maybe even repeal all graduate student loans, and definitely repeal the Parent Plus loan program. and let the private market step in.
Right. This is great. I mean, one theme, and aside from Grad Plus and Parent Plus, which some of us have banged our spoons in the high chairs about in the past, what was interesting is that we're here. We're not in a bleeding heart place, and we don't have a bleeding heart panel. But I didn't really hear anybody challenge the notion that essentially the government should make sure that 18-year-old kids with crappy credit or 18-year-old kids with billionaire parents, but that everybody should be eligible for a government assistance that's going to help you have an affordable loan burden to get access to higher education. Does anybody on the panel think that should change?
Well, I did have the view that some of the schools with multi-billion-dollar endowments, you could really question why are they in federal loan programs.
So in terms of shrinking the types of schools that are eligible, that's an interesting idea, because as all of you guys know, there have been a lot of problems where certain schools, not just the ones that have multi-billion-dollar endowments, but other schools have sort of failed in putting students who have loans into jobs that they can then pay them back. Let's talk a little bit about the skin in the game. Maybe Rob can start by elaborating on how you think schools could be forced to sort of do their part as well.
Well, if you look at the current law, there are requirements. I think schools can be disqualified from the program, but you have to be really bad, I think, to get kicked out of the government loan program. And it's mainly been...
You have to be a cosmetology school.
Yeah,
basically.
it's mainly been
And that's
some
only
for-profit
recently.
schools. Right, it's mainly been some for-profit schools. So I think that there should be a sliding scale. So maybe the amount of disbursements from the federal government depends on the outcomes. I'm not talking about the gainful employment rule, which was just applied to the for-profit schools, but...
That's not accurate, but okay.
Okay, well...
It applies to all schools that are in that category
In the category
of being eligible for student loans only because they promise students that they will be gainfully employed, which actually the most of them are community
But
college.
maybe it should be applied broader, I'm saying.
Okay.
And I think that you could slide down the scale, so schools that don't have good outcomes get less disbursements. There's discipline on there. I think the point we made on Grad Plus is there's zero discipline on schools for tuition control. In fact, it's just a runaway. They can charge whatever they want because it's cost of attendance. So the Grad Plus program proliferates tuition spiraling.
And I think it's important to kind of talk about why the skin in the game is such that it is. So when people created the student loan program, it created with the idea that there should be some accountability for schools in some way. We had cohort default rates, and later on, more recently, kind of other things. I don't necessarily know if that's the point of this panel, but the idea initially included that terrible schools shouldn't get student loans. I think it'd be useful for us to kind of investigate why almost no one gets kicked out. Basically, schools lobbied so that the requirements were so high that nobody gets kicked out. So coming up with kind of another mechanism, and for years and years then we kind of said, well, no, the cohort default rate isn't appropriately broad enough, doesn't go out long enough to go kind of beyond the period of which you would be in loan rehabilitation. So there's kind of always been this idea on a bipartisan basis that schools should have some kinds of accountability. And I think we should just kind of remember that and consider the fact that the reason the accountability is toothless right now is because people lobbied that it should be.
Well, look, I think, some of the interest in the skin in the game concept, right, is basically the reason why we're interested in that, and the reason why we have gainful employment goes all the way back to your point, Mike, of the whole point of this program is to not underwrite and to not restrict credit based on good things and bad things. And we've taken out private lenders who would normally do those sorts of things, right? Does SoFi have skin in the game?
Absolutely.
See?
We haven't
Right.
taken a dime of federal money.
That's right. So,
We had to go to the capital
and if
markets.
the student does
finance it.
poorly,
Then we lose.
you lose money. So essentially, what you have here is Congress said, "Geez, we got to get private lenders out of here. We don't have private lenders, but we'll make loans to everyone, no questions asked." And then they sort of looked around and said, "Wow, we're making loans to everyone, no questions asked. We should probably ask some questions." And so that's been the policy. But what has happened? There's some confusion now that I see, for example, in President Trump's staff statements that I read earlier, or Congresswoman Virginia Fox's statement. And what I think is they believe, mistakenly, that the guaranteed loan program, because it involved private lenders, also included this skin in the game and this underwriting that would go with a private market. But it really didn't.
I've never heard that. I've never heard them ever say that they thought that the FELT program allowed you to deny loans to students that didn't take out, those type of professions. But maybe I'm missing something.
Yeah, but
So-
the notion of saying that returning to FEL would reintroduce market forces or market mechanisms, I think implies that that's the
okay.
case.
I think that's
It's a federal program.
Yeah,
I
so,
mean, it was the first word in the program,
Right.
the Federal Family Education Loan Program.
Yeah, I
Of
mean,
course
if you
it's a
look
federal
at,
student loan program.
for example, like a Wall Street Journal editorial from a few years ago, that they've said, oh, the run up in student debt and all of these defaults was predicted by the people who opposed doing away with the guaranteed loan program. It doesn't even make any sense.
I think there's a lot of confusion, though. They think of the private loan market when they're talking about that. And the private loan market is, I think, totally different.
Yeah.
Because that
Yeah.
is market-driven. And
Right.
Yeah. I mean, one thing I will say on the risk sharing, which I also call the blame initiative, we have to blame someone. So here we're going to blame colleges because we used to blame lenders, and they're no longer in the program, so then we got to blame someone. So now it's the colleges. But I do think if you're going to hold people to a higher, you're going to hold colleges accountable for their default rates or whatever metric we come up with. You've got to recognize that colleges need to have some ability to impact those default rates. So I mean, to a certain degree, we do have a system where you can't deny loans to anyone. You have people can you can't to a certain degree restrict how much borrowing that a student can do. And we're going to hold colleges accountable. So that I think there's going to have to be some type of balance. I mean, if we're going to hold colleges accountable for some type of risk sharing, and they're going to have to put a certain amount of money in a fund based on their defaults, then we've got to give them the authority to kind of deal with these default rates
So
that are, in my opinion.
determine who is in their classes. And this is both the good part and the bad part about risk sharing, right? So colleges, except for open access colleges, so I would say community colleges, which have to take everyone, is put it in a separate category. But if you are someone that has some type of admissions requirements, for some reason you thought it was appropriate to charge them tuition and you were comfortable taking their tuition, but you're just not comfortable if you're on the hook for a percentage of that tuition. So I think there's some level of, and I actually would be one of the first people to say when I first heard about risk sharing, I wouldn't want colleges to overcorrect and say we're not going to take a chance on marginal students because we're going to be on the hook. But I do think we should just be careful to say that colleges don't have any control over what happens to students. That's ridiculous. Unless you have to take every student, many colleges have various kind of ways of determining who's in their classes. And I guess that's what I'm saying. It's the good and the bad, but it's not the case that they have no
I think it's
control
helpful to think
whatsoever.
about why we would talk about imposing a risk-sharing regime on top of a market-based system to begin with. I mean, if we recognize that higher education operates essentially as a market, but with a very high level of federal intervention, right? So we wouldn't go into the automotive industry, and say, how can we get Ford to have more skin in the game with their products, right? And there's a couple of reasons. One is because there's much less intervention in that market, right? So we have a third-party payer problem with higher education, which is a theoretical justification for a pretty heavy-handed accountability system. But on the other side of it, we also have private dollars that are being spent in higher education. And just like when private dollars are being spent in a market, the accountability comes from people observing quality and choosing where to spend their dollars. And I think that's a piece of the current accountability system that's not working very well either, largely because of the lack of information on the front end that the students have, not just about outcomes, which I'd like to see a unit record system, which would enable people to have access to outcome information by program, but also a lack of information on how financing works, which is really creating a barrier between what we have today and what I'd really like to see, which is a system where consumers are playing a role in the accountability system. And I think that's got to be part of the conversation too.
Let me just interject here because let's talk about what the Obama administration did, right? Because they at least tried to address some of these, maybe not the simplicity problem, but certainly the information up front with things like college scorecard and the changes to the financial aid forms, and certainly the accountability on the back end. They tried with things like gainful employment regulations and other efforts to sort of try to show that these colleges that are getting student loans, and in some cases, they're really, that's pretty much covering the entire tuition, that they're producing some kind of outcome. Let me throw it open to the panel. Like, what did they miss? What should they have done more? Because obviously the discipline isn't coming from private lenders on this stuff.
I think we pick on them a lot for the complexity, particularly on the repayment side of things. But I think that's actually an unfair criticism, because what they did was effectively create a safety net that is universal. It's a very ugly one. It doesn't work particularly well, but a lot of that is because of the challenge of passing legislation. So we would need HEA reauthorization in order to get a universal plan. So I don't think that's a fault in what they did. In fact, I think creating the universal safety net was an important step in the right direction. Also, the improvements in data availability were really huge innovations. I think they need to go further, but they should be commended for both of those things, I think.
Well, I mean, my own opinion is that I think one of the things that we've seen, at least within those 8 years of the Obama administration, is kind of this fundamental, I think, movement away from a student loan program, as I talked about in my introductory, to kind of a student assistance program. And, you know, I think with income-based repayment, you know, and the challenge that may have, you know, long term, the kind of the message that sent, I think, to folks as far as, you know, how much loan debt they should take out on the front end and how much that they could be repaying back. I think that's, you know, one of the challenges that we're going to have to deal with over the next few decades. One of the things that I think that a lot of the FFELP players did is, you know, and many people think that the student loan industry was private lenders, but there were a lot of state and nonprofit players that were also involved into it. So I think moving away from the old system, and no one's advocating to go back, but you really do need to have kind of this dialogue about, you know, what is the state's role in higher education, and what role should state and nonprofit organizations, the authorities and others that are out there, because, you know, states are part of the triad, you know, involved in higher education. I think right now we largely have a federal system that is being charged with, you know, setting higher education policy, and I would probably, that's just one of the criticisms I think that I probably would hit them on, is, you know, where, you know, whether or not we weakened a little bit of the triad. Obviously, states pulling back on appropriations, lack of family income, all that had an impact, you know, on that. But if I, you know, had to do two criticisms, that's probably what I would focus on.
If I would say, and I'm not advocating to return the FFEL program, and I think there's a lot of justifiable criticism of the old FFEL program, but I do think that the lenders did perform a lot of services for the schools, and the guarantors perform services that's gone away. That's probably been detracting from the performance. And there were a lot of services and value adds that lenders, because there was competition, as crazy as it sounds, with a homogenized product. There was competition around the edges at the school level that I did think, well, it had excesses, you know, like the gifts to financial aid directors. It also had some benefits. But I would really fault
the competition.
The competition was to be
Lower interest rates.
you know, there were
fees.
discounts on the interest rates. There were you know, better private loans for the students. All competition for the preferred lender list. Again, with a commoditized pretty much product, because it was statutorily driven. But I would really fault the Obama administration Department of Education for failing to really even enforce the rules. I think they did a terrible disservice to a lot of the students in the prop school sector by letting some of the bad actors just grow their loan volume tremendously. They didn't kick this, I mean, they just let them, you know, the revenue, and part of it was bad policy, like the 90-10 rule, which I won't blame on the Obama administration, but that's an insane rule that the prop schools would come up with, you know, private loan programs to make the 10%. Yeah. And they didn't care if the students defaulted, because they just wanted to fill the seats. So
schools game the system. The Obama administration tried to get around schools gaming the system with gainful employment and the CFPB working in partnership to try to, and it's the Obama administration's fault because the schools did something terrible as a result.
How did the CFPB help those students who were displaced?
So they should have acted earlier.
Yeah,
I mean,
they didn't help them.
Well, I think I'm not here to defend necessarily the CFPB, but it's an interesting criticism that what they did was right. They just didn't do it early enough, given the lawsuit that prevented the rule from being enacted when it was supposed to be enacted. And then governing is hard.
No, but they had other means outside of that.
Sure. I would actually critique the Department of Education, and it's really not necessarily just the Obama Department of Education, but the Department of Education that was not doing this kind of oversight in the Bush administration. And the Obama administration, I was there kind of February 2009 with Bob Shiver when he took a stock of everything, and I do not have any I do not wish government service on my worst enemy. It's really, really difficult. It's really difficult to figure out where things are. It's really difficult to get staffed up early. It's really difficult to figure out how to use the tools at your disposal to cut things off. So I think that's a fair critique. I just think it's a critique not necessarily just of President Obama, but of
I would agree with that.
other folks as
I would
well.
agree with
I can't even remember what your initial question was. I was so distracted by, not distracted by, they think you all had great points. And so I was thinking of saying something, but then I was listening to what you all were saying, and I forgot what the initial question was.
So I'd actually just quickly like to clarify something, though, that Rob said, and this is something actually I spent a little bit of time on in the paper. Is this one of these sort of myths, I think, that's out there that is helping to motivate perhaps a return to the guaranteed loan program. So, for example, nobody here wants to do that, but people who have some say in the matter, the president and the chairman of the education committee, have said on the record they do want to return to it. And the point is this: was there better service? Was there better loan performance in the guaranteed program? Because that's the other thing, to Beth's point, the implication is that because we're private lenders, there was better loan performance. And look, I work at AAI. I'm inclined to believe that if the market is involved, the product will be better. But this is a case where that wasn't true because the guaranteed loan program was designed to preclude any differentiation in the product and to preclude underwriting, right? So that's what would actually allow you to have better performance, is to not make bad loans in the first place. So, for example, in the paper, I show from 2008 a table in the president's budget that shows the default rate between the two programs is the same. There's no difference. There's no difference in defaults between doing direct loans or guaranteed loans. So no matter whatever the services were they were providing, it wasn't making any difference in terms of defaults.
And they should have been doing better because the lenders could not cherry pick students, but they could cherry pick institutions.
That's right.
But it's the same people doing the service. I mean,
Yeah.
there's a misnomer. I mean, the government loan program is administered by the private sector.
Actually, that has been the point of the program since the beginning. So private capital involvement is different than private sector involvement. And there's a ton of private sector involvement right now. The same companies, to your point, are servicing the loans behind the scenes. And that has always been a point of contention when the program was first started. And I would just add, it's interesting how policies, kind of morph and become associated with certain political people. The direct loan program was an idea that came out of the Nixon administration and was part of George H.W. Bush's initial budget proposal. And it quickly morphed and became more of a partisan issue over time. But I would just note that the idea itself was conservative, when it was like, why are we giving away money, essentially corporate welfare, to these people? We should save money by not doing that. And so it's just interesting that it's now kind of seen differently.
I want to push back a little bit on kind of some of the aspects that on the report, because I think it depends on kind of what type of services that you're talking about. I mean, I think what kind of Rob is talking about, is the fact that there was competition, amongst lenders, on the front end. So in many cases, significant origination fee cuts, significant, interest rate cuts. Right now, if you're a parent, for example, you're almost paying 10%, into your interest rate as well as your origination fee, and that I think to a certain degree is ridiculous whenever they can get a better product from the private side. But under the old program, you did have those particular borrower benefits. I think you had the intensive financial literacy on the front end, college access. A lot of the agencies ran college access programs. They ran these websites. What you've seen over the last few years, as more folks have gotten out of the program, is that some of these sites haven't been updated. The programs have gone away. I think to a certain degree, we're kind of seeing some of that, which is that folks really just don't have this basic understanding of, of kind of the basic budgets and kind of other aspects that are out there. I think on the back end, there was a lot of discussion on, intensive kind of delinquency services and kind of default prevention, aversion, kind of helping people, deal with all of these different aspects of it. So, part of it may not be measured, as far as the overall default rate, but I'm not going to, I think it's important that we not discount the services, that were provided. Currently, right now, a lot of obviously the 9 servicers under contract with the U.S. Department of Education have that role within the direct loan portfolio. The question that we have a lot is whether or not those servicers are doing basic due diligence, or whether or not they're spending, intensive time with borrowers, sitting with them on the phone, talking to them about the various repayment options that are out there, talking to them about how does their cable bill differ than their mortgage, and how does all that work within their student loans. So, I do think one of the things as we go forward is that the U.S. Department of Education And Congress, especially within the reauthorization process, has to determine, what do we do with students on the front end as well as the back end to ensure that they, are aware of their repayment obligations and that, we are providing the assistance to them, not just the bare minimum. And the problem we have a little bit within the current program is the servicers are not compensated very much to, to service, on the direct loan portfolio. So I think for what I'm saying is that, no one wants to go back to the old program, but, let's not discount the fact that there were some good things that can be incorporated, into the direct loan program.
Could I just discount one of those, though?
Yeah, go ahead.
So you mentioned how the lenders would cut the fees that borrowers were charged. Right? Well, there's nothing magical about private lenders reducing fees in this program. It's not like two private entities competing to drive down prices. What they were doing is the government was saying, here's a block of money, right? Pass it on to the student, right? And so what they were doing is they were saying, well, gee, I got to pass most of that on. And another lender would say, you know what, I'm going to pass more of it on than you, right? So they're just competing to pass on a government benefit. In fact, the government in the direct loan program can set any terms it wants. If it doesn't want to charge an origination fee, we can pass a law. Don't charge an origination fee. There's no competition determining the terms of the loan.
Jason, I think the program got much less profitable over time.
And
the private
sure,
lenders.
that's right.
Because I know towards the end of my tenure at Sallie Mae, it wasn't that profitable. They had really in the beginning, the special allowance was quite wide, and there was, but over time, and more lenders got out of the program, so you could see that it wasn't as profitable. Because I think from your paper, in the early days, there were thousands of lenders in the guaranteed student loan program. There were very few left before CASLA hit.
Let me try to bring it back to Jason's original question about private capital, because actually SoFi and other companies are actually bringing private capital into the student loan program, right? I mean, we still have this government program where anybody can get a loan no matter how lousy your credit is. But then SoFi is coming around and saying like, you look good, you look good, you look good, and refinancing, giving people better deals, which is reducing the scope of the government involvement in the program, but of course is also leaving the government with kind of the lousy credit. But you can sort of see how that would work. How big do you think this can get? Is this sort of a model for just a kind of bifurcated program where kind of everybody gets a loan and then everybody who can refinances it? Where does income-based repayment fit into that? Can you elaborate on that?
Let me just start on that, and I'd like to give people a sense that it was very, very difficult to develop this product. I was one of the very early employees at SoFi. We went to Wall Street, and basically it was come back in 3 years when you made $100 million in loans. We went to the rating agencies, come back in 5 years, because we're done rating new companies after the financial crisis. And it was block and tackling. We raised $80 million and spent it making loans, not what our equity investors had in mind, to prove that we could do this. And our history has been always, people say, well, you're just skimming the cream. You're taking the best borrowers and leaving the bad ones in the Department of Ed. That's not correct. We've expanded and expanded through our short history to now where when we started, we were making loans to graduates of like 10 schools because we had a flawed model of trying to raise alumni capital, which couldn't scale. Now we're making loans to people who've gone to any Title IV four-year program. And we've made loans to over, I think, 2,500 graduates of 2,500 schools. We've, and 20% of our borrowers make under $70,000, so not everybody is well-heeled. But we're not a bank, and so we have to convince the capital markets to finance this. And the way that's been done is performance-driven and underwriting. So we have an extremely low default rate on the student loan refi. We're averaging about 10 basis points of credit losses, maybe less a year, which is blowing the rating agencies' models out completely. It's incredibly performing, and that's letting us lower our cost of funds and expand our program. So now, there'll always be a limit, I think, on refinancing because the private sector is not going to refinance people who can't afford to pay because the model just wouldn't work. But what we've done around the margins too, which I think has been a great idea, is we've developed a career services center where we employ 10 people. We help the borrowers find new jobs. We've done it like 200 plus times. We're helping them with their career. And so there are some people, it's a trade-off because you can't unscramble the eggs when you refinance. You've given up your government benefits. And so if you think you're going to go into government service, if you think you're really going to be in financial hardship, you need to stay in the government loan program. But I mean, I don't know why people who work hard, improve their credit, they can refinance their mortgages. Shouldn't they be able to refinance their student loans at a lower rate?
And your incentives are right because you want people to do well. Is there a downside to this model, to growing
it's
it?
a private program. I mean, it's a private business, it's a private company, it's a private program, which is fine. There's tons of those. I guess the difference, so, if you have a mortgage, the reason you have an FHA mortgage, and the reason, to your point, the reason the government is involved in markets is because it's performing a function that the private sector wouldn't. So the entire reason that there's a government student loan program is because it's supposed to cover the folks that the private sector wouldn't otherwise. Otherwise, there would be no need for a government program. Why do we have an FHA program? Why do we have government assistance in any way, shape, or form at all? I mean, I think it's not to say that SoFi is skimming the best credited borrowers, regardless of their income, off the government program I don't know why that's like a big secret. It's fine, it's like that expected that there would be some people who are more likely to repay and some people who are less likely to repay, and you're not going to take the people who are least likely to repay. They're going to stay in the government program because otherwise they wouldn't be able to get a loan. And so the reason the government even got into student lending to begin with is because banks and others were not lending to students and I think the idea of underwriting, particularly for people who have no credit history or no whatever, the whole point of going to college is to improve your financial well-being. So it's hard to say right now, but for the fact that I'm going to college, no, I don't have the ability to repay. It's all hinged on this bet that I'm making right here. And that is kind of why we say when colleges writ large do a poor job in making good on that bet, that the colleges are the ones that should be at fault and not the individual who is just trying to, get their part of the American dream and do a better job. So I think it's really difficult to think about how do you appropriately underwrite without underwriting the institution and starting to look at student characteristics when the whole point of the student going is to better themselves.
Go ahead.
The concern, I think, with underwriting is not what's happening with SoFi, which is when there's a market happening in parallel to a federal program, but rather if we were to adopt some of these proposals, which is to scale back lending for graduate students, for instance, what are the implications for access, right? So the argument I hear a lot is if you take away PLUS loans for parents, even, or if you take away these Grad PLUS loans, you're reducing access to higher education for disadvantaged or low-income populations, which is against what all of us wish to happen. The problem with that is I say that giving loans to people for bets that are not good bets is not a good way of closing the access gap or the completion gap, right? That's a mission that should be accomplished through grant making rather than through lending. But I think that is the primary opposition to allowing the private market to kind of come in and cover some of the portions of the market that are currently being covered by federal programs.
Since you brought up my hobby horse, I gotta ask about Parent Plus. The parents, they're not building human capital. It's a weird bet for them, right? They can take out unlimited loans, and all they're doing is getting closer to retirement. Does anybody think this is, and those loans the interest rates aren't nearly as low too. Does anybody think this is something that the government should be doing?
I mean, one thing I think is as important to kind of throw on the table based on the last question is that right now, many people may be surprised that if you look at the portfolios of private loans in the United States, 86% of loans are undergraduate loans with a cosigner. 14% are graduate loans. So, everyone kind of talks about, which is weird to me to a certain degree, because if we look at the Grad Plus and the Parent Plus, those are the programs to a certain degree that are geared toward folks that, they've already secured their undergraduate. They may have, I think you question whether or not, that is the proper federal role. And I think on the parent side, I think Mikey raised a really good question, which is kind of, at the least what we should do, on the parent side is one, either cap it. That's the way the federal government has traditionally kind of, addressed over borrowing. Or number two is look at ability to pay. Because if not, we're going to continue to face these government accountability reports that talk about the number of parents that are saddled with debt and they're still paying it back, as they get older and older, and they're not able to save for retirement and a variety of other things. So I do think it's a challenge. But the access issue, you raised a good question, which is, where is that kind of balance? And, how is that a bad federal policy that we are basically giving folks unlimited loans that they can't pay back? So even though their kid may be getting an education, we've made the family situation much worse.
Right.
But here's the weird part, though, about Parent Plus, right? Jay just say, let's have an ability to repay test. But if you pass an ability to repay test, what in the world do you need a government loan for? It doesn't make any sense, right? So we've started out with one absurd policy, and to try to make it better, it just gets more ridiculous.
Well, and
right?
we have ability to repay in mortgages. So the legislators have said we want an ability to repay in mortgage because we don't want a crisis again. But there's no ability to repay for Parent Plus or even grandparents taking out loans.
And I understand how you start with this unlimited program with really no ability to repay test, and you think, oh, that doesn't make any sense. Let's introduce an ability to repay test. Where actually you need to go back the other way, which is why do we have a government loan program for people where they need to pass an ability to repay test?
Well, that's a question.
But that's
Exactly.
also the fact that it makes
No,
a lot of money.
yeah.
Addicted
But
to
that's-
it.
But politically, it's hard to get rid of because of the fact that it does raise
it
money. But I
raises
think
a
you
lot of
have to
It
continue to
raises
say
a lot of money
there
when
are
you're
lots of
looking
things.
at the balance sheet.
But the
and you're
fact that
trying
it
to-
makes a lot of money is a reason
no, it's
that the
not
private
great.
market could do it.
Right.
Oh, I'm not necessarily disagreeing with you. I'm just saying, like, when you're looking at these things and you're trying to figure out in a budget-strapped environment where the effort is to cost, like to save money, it's hard to be like, I'm going to give up however much the subsidy is
It's
on
the
Plus, which is
highest
crazy.
rate and the
Yeah.
lowest default portfolio
Yeah,
in
it's
the government.
just-
But
loan
that's so
program.
that's a really good point, though, I think, for all of you when you hear, we need to bring private capital into the loan program. So when you hear somebody say that, you say, or we need to get more private capital, we need to get the government out. Say, okay, well, seems like you should start with Parent Plus. Like, oh, no, I don't think so. Like, okay, well, so you were never really serious to begin with. I mean, that's essentially, if you can't start there, if you want to talk about paring back the government role and bringing in private capital, but you can't even start with Parent Plus, you weren't serious.
I would just add, for those of us who are federal loan geeks, that this kind of conundrum applies not just to student loans, but to FHA loans, to MARAD loans to shipbuilders. There's always the, that's a risky loan, and then on the other hand, oh, if it's not a risky loan, then why are you doing it? And so this comes up again and again.
What's the answer? You're supposed to tell us the answer.
This was going to be a final question before we get to the questions. Was for the Trump administration, as they look at this, if there was something quick that they could do to at least say they've done something and that would move the program in a good direction, what would you guys recommend? What are some quick policy moves?
I'll continue on this theme of the private capital. One, I think paring back graduate and parent lending should be a priority, and that achieves the goal of getting the private sector back involved in federal lending. I think if you wanted to restore private market participation in federal lending in the undergraduate program, there are ways to do it. I mean, part of what was wrong with FEL was essentially it was government contracting with the private market players to do an activity that they could have done themselves. They realized the contract they made was flawed. It created bad incentives. And so instead of rewriting the contract, they said, let's get rid of the contract and do the activity ourselves. So there are ways to recontract with the private market to outsource the financing of federal student loans. I don't think that should be the priority. I think there are more important things to think about, particularly paring back who has access to federal lending to start.
My thought is that it's going to be Congress that's going to really set higher education policy over the next 2 years, and so for the administration to kind of come out pretty forceful on student loans when there is potential for a reauthorization, I think is pretty dangerous. We never, I worked on the Hill a long time, so maybe I'm kind of biased. Kind of wait and see, kind of what's going on. But my own opinion is, I think the federal government runs a student loan program. In order to do that, I think there needs to be professionals that are over at FSA in order to kind of look at how the very operational of that particular program. And then secondly, as I talked about before, I would focus significant effort on the front end to ensure that students are well aware of what is the best career that they should go into, what is the best college that's for them, and part of that is an affordability aspect of it. Where are they most likely to get a job after they graduate, how much they're going to have to repay, and how will all of these different aspects of it interact with their other needs that they'll have. So I really do think that there needs to be a pretty big focus on the front end, because right now a lot of the criticism is on the servicers and the collectors. Well, I mean, by the time the servicers and the collectors get it, the cake is pretty much baked. The kid already has a student loan. The kid has already chosen the school that they've gone to. They've already graduated. They've already chosen the career that they're going to go into. And here the servicers are being asked to help compel payment from someone. And there's no assets, there's no collateral, based on it, and all the life goals that they've made before, the servicers and the collectors are receiving that account. So I do think there needs to be a conversation about kind of where the focus of the federal role should be.
Well, I'm going to just stick to, the quick hit is what Beth said, which is limiting the limits for the Grad Plus and maybe some of the other programs. I think two other radical ones, which most people would disagree with me on, would be the point that I made earlier, which is maybe either lowering loan limits substantially for private schools, non-state schools that have tremendous endowments. And a third one, which is also radical, would be allowing for differential pricing based on what the student studies. So you're trying to encourage them to go into engineering or STEM and maybe give them a lower rate or incentives if they graduate on the loan. And so that's a radical, I think that's more of a radical proposal. I think the quick fix is what we talked about.
You asked for a quick fix that's within their control. So capping plus loans, getting rid of them is not within the control of them. And I would say
That's true.
It's a mess of a bear to go in and try to figure out where you would balance the budget sheet on that. Save whether it's a good idea or not. What is within their control and what is something that we talked about is completely within the purview of the Department of Education and has fallen down on both Republican and Democratic administrations. That the Trump administration should really be poised to do a good job on is program integrity and enforcing gainful employment and all of the other program integrity regulations so that schools do not continue to have this problem where students are taking out bad loans and causing defaults in the program long term. And I think that's an easy thing to do because all you have to do is stay the course. I would just say on the idea, this often comes up, the idea that we should differentiate loans based on, you've got it, I think, a little bit opposite. Like, why would you give, and you don't need to, people are gonna make a lot of money on engineering, so you actually don't need to incentivize them with a lower rate. If you're trying to, I think it just depends on your purview. What I would do is subsidize the people that are going into the humanities because they're not likely to make a lot of money, so why would you give them a super high interest rate? Then they still go into it, and then they have a high interest loan when they're not making any money. So there's definitely a way to do what you're talking about, but I think it depends on what goal you're trying to achieve on the back end.
Yeah, so this setting different terms for different kinds of programs is actually, this is a big trap for Republicans and sort of free market conservatives, which is they think, well, I see all these bad investments being made, and so I'd like to get in there and tell you which one is the right one, right? But here you have people who say, I'm a free market, small government person, but I also know what's best for you, so let me set the price, right? It doesn't make any sense, and I think that the Trump administration and other Republicans should completely stay away from that. But in terms of a quick fix, look, if they're not going to limit Grad Plus loans, if they're not going to limit how much graduate students can borrow, maybe a limit, a place to start. Here's a quick fix, a really, kind of cheap idea, which is, if you want to get an FHA mortgage, you can only borrow $400,000. Well, maybe that should be the limit for Grad Plus. It seems like you shouldn't be.
Refinanced the $600,000.
Right? If the limit for a house is $400,000, maybe this other loan program should be at $400,000 limit too.
This is great. I'm sorry we couldn't keep that going because at the end we were starting to get into the question of sort of what is college for, right? Which is sort of an underlying this whole discussion. But I want to open it up to any of you. I think are there microphones? Did you say or no?
Yeah, there should be microphones.
There are a couple microphones.
Yeah, so it's.
Oh, there we go. So why don't we start in the front row here and.
Oh, she's over here.
Which one did you call in?
Right here in the front row.
Okay.
Thanks. And this has been a great panel. Peter Warren with the Senate Budget Committee, Chairman Mike Enzi. Thanks for doing this. This has been really good. One thing that you just touched upon a little bit towards the end, I think has been sort of lurking in the background of this discussion, sort of the 800-pound gorilla in the room that is sort of the context for federal student loan policy, which is, and this is something that was sort of occasioned by the switch once we went to 100% direct lending, which is that the marginal cost of student loans is less than zero. Under the current federal government accounting, think about what impact that has on policy. That additional loan, it used to be when you increase loan limits, it cost money. There were trade-offs involved. But now you have a situation where the more you lend, the more money you make. Jason has written about this. Michael, I think, has also written about this. But it's hard to overestimate the impact that has on policy. Just to give a couple of examples, I mean, once you're at that place, and again, I think it was referred to here, the Grad Plus program, whatever one thinks about having an uncapped loan program, you're sort of faced with a dilemma, because ironically, if you reduce that loan volume or you cap it, it's going to cost money. And so I don't think it's coincidence, what we're seeing. We have seen dramatic increase in federal loan volume. We're up to $100 billion a year in new originations. I think some of the policies of the Obama administration, and let's face it, over the last few years, most dramatic changes in student loan policy have been accomplished not by Congress, but by the Obama administration, the previous administration. And I think Ms. Smith referred to the limitations on what you can do, like you can't cap Grad Plus through administrative action, which got me thinking, well, maybe we should think on that, because I think people used to think that you couldn't change the income-based repayment policy that Congress had put in statute administratively, and yet that was done.
Some creative policymakers.
Yes, very creative. Exactly. I take my hat off. To the tune and the expense by the administration's own accounting, the Obama administration, tens of billions of dollars of expense. But again, it's hard to notice that expense when all you're doing is marginally reducing the massive profit this program's making. And again, there's an ongoing debate over how we should correctly account for all federal credit programs. But if you look across the board, like Michael has done, and you look at the different loan programs, the one where the rubber really hits the road in terms of impacting policy tends to be federal student loans. And again, back when you had DL and FELP, and most of the volume at that point was through FELP, all these questions about changing all these decisions, there was a cost on net involved, and now there's, it has completely reversed the incentive. And just to give one example is...
I can respond to this budget, to your budget.
I just want to say one last point, and then I'll surrender the mic.
And all this leads you to ask.
Yeah, yeah. Well, I'm setting the table for you. I just want to get this out there, because I think this is sort of underlying a lot of what you guys, what's in terms of what is the role of the private sector, and why we don't have a role of the private sector, because there's an extraordinary profit here being made. Pell Grants. Why do we never talk about, now there's no reason to talk about a trade-off between student loans and Pell Grants under fair value accounting, an alternative mode of accounting that CBO has advocated. Well, there would be a very significant cost to student loans, and Congress would make decisions. Well, are we better off doing $100 million more in Pell Grants or $1 billion in student loans? But that's not.
So I'll answer this question about, this budget issue is an important one. Right, but what's happened here is essentially Congress has rigged the budget rules to make it look like these loan programs make money. Right? So normally what Congress does is they created an entity called the Congressional Budget Office, which is charged with telling Congress what its proposals cost. Right? And so CBO has wide latitude to determine, to give Congress the best estimate that they think of a proposed change. Except with student loans, except with loan programs. Because what Congress has done is they've said, don't give us your best estimate, we'll tell you how to do the estimate. And they said, CBO shall use, right, this particular method for producing the cost estimate. And it makes the loans look like they make money. In fact, so that's a sort of complicated answer, and that needs to be fixed. And the reason why it's an issue is that Congress has written a law that prevents the CBO from giving it the right information, which is why you have CBO saying, please change this law. You're making us look really dumb, right? And the dumb part is everything you've heard today about this loan program. It makes unlimited loans. It asks no questions. There's income-based repayment. There's loan forgiveness. We're making loans to for-profit colleges where people have very little chance of paying off. But it makes money? There are 8 million people in default. But it makes money? It just doesn't make any sense. And I think that's why you want to listen to CBO.
Oh my God, I thought as I was driving here and I was parking, I thought I was going to be on a panel about maybe private sector involvement in student loans, and it hit me. I was like, oh crap. I'm going to be on a panel and we're going to talk about fair value market accounting. And I was like, no, maybe I should leave. And then we got to the end and I was like, oh my God, we got to the end of this and we didn't talk about fair market value.
Wow.
So then, yeah.
I mean, one thing I thought was kind of interesting, and maybe this is an issue as well, is that whenever, just kind of in the last few years, when we were kind of looking at kind of trying to get some a policy proposed around how much we could interact with borrowers and call them, I'd heard that the Congressional Budget Office said that the federal government did not make any money off of, or actually they didn't lose money off of defaults. So the CBO had a 0 score for defaulted loans because they believe that the federal government, everything will be repaid no matter what.
Well, the
So I think-
federal government is an awesome repo man. They have.
Well, now there's nothing to repo.
Yeah.
I mean,
But, well,
look,
I don't
should
know,
we-
that doesn't really square with
Do you want
what
to take
you said
the
earlier,
next
though.
question here in the
James.
front? I think is this woman here. Thanks.
Thank you. Thanks for the panels for very good presentation. My name is Li Yang. For the student loan, first I wonder why is it necessary doing the way currently doing. Basically, so what we didn't really do a good education for K through 12. Instead, they push you to the college, just saying you will get a higher earnings. Why don't we just put the budget to like K through 12, then everybody graduate from there can have a good employment and good earnings. Second is we put just a student
Somebody
loan.
want to take the first one?
I think it would be
We'll
great
try
if
to
people that
stick to one
graduated from
person.
high school could have a middle-class job without having to pay to get more things. That unfortunately isn't the case. This is borne out by the labor market.
Yeah, I think it's a great question, and I think there's probably a reason why most of the Secretary of Educations that have been nominated by presidents over the years have had K through 12 background and not higher education background. And I think there is this belief that if the federal, not necessarily federal, but if federal, state, and local emphasis is put on the elementary and secondary education system, then our high schools will graduate folks that will be able to enroll in post-secondary education and not have to engage in remedial and lose their credits, take out more debt, et cetera, et cetera. So I think that's kind of where I think the federal government, primarily the federal, state, and local focus is right now. Money, the primary, the federal government on the higher ed side spends a lot more money than it does on the K through 12 side, but the focus right now is appropriate on the K through 12 side, I'd
Let's
probably say.
try over there. Also in the front row, the one right there. Thank you. There you go.
I'm Farron Powell with U.S. News and World Report. So just 2 questions. For consumers, what can they expect in the private lending market in the near future? And is there a reason why we saw Sallie Mae's stock nearly double after Election Day?
Well, I don't work at Sallie Mae anymore, but I would think the stock
Do you still have
rise.
stock?
No, I don't. I don't have any stock. And maybe Shelley Rep can answer this too, but I think it's pretty obvious that it was the point that was the lead into the panel, which is, people thinking that perhaps the private sector was back in play for student lending in a broader way than, and as Peter explained, that's not going to happen because of budget realities. So I think that was the reason for the bump. But I do think there is, when we started in the refi business, I think we were the first to refinance private federal loans into private. There's a lot of players coming into that market, so I think you'll see more players come into that refi market and more players go into, particularly if there were any curbs on Grad Plus, many more lenders going into that
How
sector.
big do you think it'll get?
Well, what's the size of the grad loan market? Jason knows this, so
The size of the entire grad loan
Yeah.
market?
it's a fairly big market.
Yeah, I mean, it's like, so in terms of the federal program, it's somewhere around, of the outstanding debt, it's somewhere around 35% of it.
The one thing that is kind of a hesitation for a lot of private lenders, I think, is the regulatory environment and the perception that there's a lot of regulatory risk with the CFPB. You can see that with some of the actions the CFPB's taken. So that's been a curb on private sector involvement, I think, in student lending, is the regulatory risk. And for the large banks, I think it may be just not large enough of a market for them to play in it.
I mean, one thing I will say,
Gentleman
I
right
agree, I
next.
think the regulatory side.
Can I just follow up on one thing? Should
Just
we
a moment.
expect to see more players in the market?
I think it depends, on the policy changes and the point I made, which is the regulatory environment. A lot of people perceive that's changing drastically.
And I mean, I'll just add, that you asked why Sallie Mae's stock doubled, right, or went way up in the wake of the election. So markets are seeing something although our panel of experts says there's nothing to see here. So it just comes down to whether or not you trust markets or panels of experts, really.
When have the experts ever gotten
And as we
anything
know,
wrong?
markets are infallible, as we saw in 2008.
Should we try the gentleman right next to you there?
Hi, thank you all for being here. My name is Barrett Mueller. I'm a graduate student. My question, though, is about college access and risk sharing. By pushing some of risk onto colleges, how do you think this will affect providing equal access for low-income students, first-generation college students, things like that?
As I mentioned, there's this balance that you have to have if you, and this exists not just with the risk-sharing proposals that exist now, but has always been the case with default rates and other kind of efforts that have been part of the federal student loan program. And it's kind of an art and a science, probably more of an art than a science. I think it's reasonable to expect that colleges do a good job with the students that they serve, figuring out what is a good job and how to hold them accountable for doing that is always going to, if you tip too hard on one side, you may risk them creaming, or if they can't cream, just changing the balance of their students in ways that you wouldn't want to see. I do think there's a far end of this, though. Like at one point, we saw many for-profit colleges like going to homeless shelters and signing up people that like have terminal brain injuries. Those kinds of things are probably, yes, we don't want you to do that, and we want to encourage you not to do that. Going to say, well, we're not gonna recruit at Atlanta public schools because we know kids from Atlanta public schools never graduate and their families don't know anything about good credit is probably too much on the side. So getting that balance right is not an easy task, but I do think there have been a lot of papers that have been out recently talking about how you could reward colleges for good behavior as well as kind of punishing those for bad and hopefully coming up with a good balance.
A lot of the regimes, can I attach to that? A lot of the regimes that we've seen have essentially proposed giving institutions a pass if they're serving students who are disadvantaged or have historically had bad outcomes. The problem I see with that is that we don't want to give institutions a pass for producing bad outcomes just because they're serving difficult to serve populations. I mean, these are the populations that we want to be at the best institutions, not at the worst institutions.
And the students have the debt regardless. So this is where I feel a little bit different than in K-12. I think you've seen a lot of conversation on accountability, through No Child Left Behind and other places, and now a lot of backlash about neighborhood schools and things of that nature. But in those cases, students and families weren't taking on individual debt. And so I do think we have to ask ourselves, if we're in colleges or wherever, is it reasonable to, it'd be one thing if it was like free to the student. You still have opportunity costs, but you're asking students to take on debt, and what service are you providing to them? And if we're not able to say with full confidence that we can, think that the majority of them are going to do a better job because of this, I just think it's a hard question for even higher education, not separate from government, but is it ethical to kind of allow students to take on debt for programs that we don't necessarily think they're going to pay off?
I mean,
Let's
I just want to add.
let's try to get a couple more before we finish. Right over there.
Hi, it's first of all, thank you for this. This is a tremendous event, really enlightening. I'm Chuck Gabriel. I'm with Capital Alpha. I'm a policy research group here in Washington, and I just wanted to get Jason perhaps to put his former Senate budget wonk hat on for a second.
It's always on.
Yeah, you
always
on.
Yeah, can you take it off?
To the extent that there seemed to be widespread.
I didn't even say it.
To the extent there seemed to be widespread agreement that the Grad Plus programs could be a great place to start, and yet on the other hand, the CBO is still looming heavily over this, or not in having to implement the quirky scoring that Jason talks about. I just want to ask you, Jason, in terms of Congress having to really be the next place where action will likely happen, do they have to change the CBO, the scoring, from accrual to fair value accounting in order to be able to repeal the Grad Plus program or pull it back? And frankly, what are the odds of doing that, perhaps in, say, a reconciliation bill by the end of the year?
So the accounting rule I talked about is actually in law, but Congress doesn't have to follow this law. That's the beauty of being the entity that actually writes the laws, is you don't necessarily have to follow them. The budget committee the chairman of the budget committee is always free to use whatever number he or she deems is the most appropriate number for the cost of a piece of legislation. And in fact, in multiple budget resolutions that the Republicans have passed in the House and Senate, they have telegraphed that they may indeed do exactly that, which is if they were to bring a bill to the floor that got rid of the Grad Plus program, that they could use this alternative scoring method, which the CBO deems is more comprehensive than the existing set. So I think they have a strong case to do that, which is the CBO has said this is a more comprehensive measure of costs. And they've said in their budget resolutions, we'd like you to produce those estimates, Congressional Budget Office, and we may use them. And so I think it's very likely that you see that in the near future.
Time for one more?
Yeah, sure, maybe one more. Yeah.
All right, let's, right there. Sorry. Yeah, yep.
Yeah, so I'm Sandy Black. I was a member of Obama's Council of Economic Advisors, and this is something we spend a lot of time thinking about. And I thought it was really interesting. There's agreement about simplification and information. All these things are really important. Holding schools accountable, I think, is really important. It's super hard to think about how you're going to do it, and because you don't want to punish the student, you want to punish the school. And so I was going to open it up to the panel, but I think we're about to end. Trying to think of what that measure is that you're gonna rate the schools on so that you're not punishing them for having a lot of low-income students is really hard. And what was so frustrating for us was that even this incredibly low bar through GE was fought and took so long to implement that I would have been interested to hear kind of how you guys would think about this how this should be done in the future, because it is such a fraught topic.
Exercise some humility. I think to understand that the higher education system is very diverse, and maybe a one-size-fits-all is not appropriate. In 2003, one of the bills I worked on when I was on the Hill was to kind of look at what universities were doing on college cost, and it got a lot of blowback from the institutions. And one of the ways that we kind of wound up doing it is that we had 6 or 7 different lists, because we had to do a list for every single different sector of higher education, and some even within that structure, even within the sector, we had to say, how many years a kid could pursue, college. So I think this gets very complicated, and I think, one of the things I'm a little concerned about in the risk sharing is that I don't want to delve into the process, and I can definitely see a bill starting at 2 pages and wind up 100 pages, and just so complicated that no one will even understand it other than an expert. From that one. So I think understanding that we have a very diverse system, there's going to be massive impact if depending on kind of what proposals are put forth, and maybe a little bit humility from the federal government is a good place to start.
I'll add just quickly to that. I have argued that I don't think risk sharing would work well as a punitive mechanism, because quite simply we can't agree on what the outcome is that we should be measuring quality on. But what I have observed is that we have income-driven repayment with forgiveness, which is essentially a satisfaction guarantee that the government provides on a product that's being offered by these institutions. So why not let these institutions pay the premiums for this insurance that they're being provided? So essentially, the costs that are imposed through the safety nets for repayment could be passed back to the institutions, either in whole or in share. And I think that would achieve something that we could agree on.
I think it's also difficult. Your question's a really good one, but some of the schools that have had bad outcomes, at least numerically, they are serving a very different population that isn't going to do as well. And so the question is, as a policy, really, what is adequate? Maybe if 2 out of 3 people who go in there come out and do get employed, is that a good outcome? Because what would those people be doing if they didn't go there? I don't know. I mean, I don't know the answer. I mean, it's a tough question.
Judging like and like is always, the best way to start with the stuff. This, though. So I just want to put that out there for, as people leave this panel and think about it, I think we often think about, oh no, you don't want to judge Hillsdale Community College next to Harvard, and obviously you wouldn't do that. You would probably judge Hillsdale Community College next to, Roanoke Community College, next to, Georgia Perimeter College, which are all community colleges, which are all open access serving of low-income students, and that would be the place to begin. And again, this, I'm just saying this for the broader, you wouldn't, from a starting salvo, say, yes, we would judge all colleges the same.
Jason, you want to take the final word?
Yeah, so I think that the way to do risk sharing is to not make the loan in the first place, let a private lender make it, and they'll share in the risk, which is how we do risk sharing in the rest of the economy.
Guys, thanks so much for coming. I really appreciate it. Great panel there.